So in this video, we talk about managing our checking and savings account. So let's define monetary assets. Monetary assets are cash and cash-like assets. They're usually very liquid, but more importantly, they are assets that we could put an actual dollar figure on it. So for instance, for your car, you know there's a value, but you really cannot say how much it is exactly. So monetary assets are very liquid and we know what they are in exact value. So we have the checking accounts that we keep our monetary assets in, and savings accounts. So through the checking accounts, what are the differences between the checking accounts and the savings accounts? So a checking account is the most liquid form of deposit that you could have at a financial institution, because you actually have an access to that money almost 24 hours a day. Now, you could write a check against the money that you own in that account. And what happens when you write a check? Well, a check simply says, pay to the order of X amount of dollars on this date. So it really gives the financial institution the right and the authority to pay to the intended person or institution, however much you wanted to pay them out of your checking account. So say you wrote a check for the person who's moving your lawn. So you wrote a check for $50. This person takes the check to your bank, the easiest, and then says, well, Mehmet wrote me a check for $50 from his checking account and I need to be paid. The bank takes that check, makes sure that I have $50 to pay him, and then takes the check, cancels it, and then pays the person $50 out of my checking account. If the person were to take the check to his institution, his bank, which may be different than mine, then let's say that I have my account at Chase and he has an account at Mattery Bank. So the Mattery Bank will take my check and will tell my loan moving person to wait for the payment. Then Mattery Bank will contact Chase and ask Chase to pay that amount from my checking account. They will receive the funds, then they will pay my loan moving person. So what happens when you write a check? A person gets paid through your financial institution from your checking account for the amount that you wrote on the check on the date that you have specified on the check, and the person that whom you've written it to. There are three special types of checks: a certified check, a cashier's check, and money order. The certified check is actually drawn on your account. So say I have an account at Chase. I go to Chase and I say I need a certified check. What they're going to do is they are going to write me a check for however much I ask them to, and then they're going to certify that I have the funds in the bank to pay for that check, and then they're going to put a hold on that amount so I cannot write another check against it. So it is possible and illegal to write a check against the funds that you do not have. So again, let's say I have an account at Chase and I have $1,000 in it. If I were to write $5,000 check to somebody to purchase some goods, that's illegal. And the bank would not pay it, and my check would bounce, and it would go to my credit record, and I can be prosecuted for it. Now, because this is a possibility, however illegal, well, a person can still write it, because crime happens every day. A certified check, however, certifies by the bank that holds the account the amount of money that is available for that certified check and puts a hold for that amount on that account. A cashier's check, well, cashier's check is something that you purchase from the bank. You basically pay the bank however much you're going to purchase, and then they're going to write you a cashier's check. You do not have to have an account. However, most institutions may require you to. However, cashier's check is simply a check drawn on the bank's account, which you have to purchase. And money order is also purchased. However, these, you can actually purchase it from, say, post office. As far as I know, Winn-Dixie also writes them. You could purchase them. There are institutions who actually write money orders and sell them to you. It simply is just a paper that says this much money can be claimed at another Winn-Dixie branch or another post office. There are international money orders. It's an easy and relatively safe way to travel with money. American Express used to actually have money orders where you can buy them in the US and go to whatever country, and then go to any American Express office and get your money against it. It was relatively cheap. I'm not sure if they still have it now that we have credit cards and international money transfers so easy. I don't know if we have money orders internationally anymore, but domestically we do, and they're very common. There's a small commission that you pay for it, and you could actually buy them from many depository institutions as well as some stores and post office. Now, if somebody writes you a check, you need to endorse the check to get paid. That is, at the back of the check, there's a little line that says endorsements. That's where you sign. Now, if you just sign your name and then give it to the bank, you get paid. However, that's referred to as blank endorsement, which means that you simply sign your name. And remember, this is a check that you received from somebody. So somebody wants to pay you, and then your name is written on that check. So you turn the back of the check on the endorsement line, and then you sign your name. So you make a blank endorsement. Now, once you make the blank endorsement, that check is as good as cash. If you were to drop it and somebody were to pick it up, they could actually get paid. You should not endorse a check and mail it, because if somebody actually gets it, that's as good as cash. It's very much like sending somebody cash through mail. And as far as I know, sending cash through mail is illegal. If you endorse it and say for deposit only, well, in that case, that check that you signed your name and you wrote for deposit only can only be deposited to your account at wherever you're cashing it. So preferably you cash it in your own institution. That can only be deposited. Or you could endorse it to a third party. You could say pay to the order of, sign your name, and then pay to the order of some third person. So you just made a second check through the endorsement. Not common. Most people just blank endorse it. However, again, if you lose it, it's like losing cash. So it's a good idea to write for deposit only. Although if you do write for deposit only, you can't get cash against it. You have to deposit the check and then get cash out of your account, which may take a couple of days to clear. Through checking accounts, you can have a debit card, and you could also make electronic transfers. A debit card works very much like a credit card operationally, meaning that it's a plastic card that either has a Visa or MasterCard logo on it, and you could use this debit card wherever you see Visa or MasterCard logos, very much like a credit card procedurally. However, when you use the money, it actually comes directly from your checking account as if you wrote a check. It comes cash, almost like a cash payment. So most stores will allow you to get a cash back, meaning, say, you bought a pack of gum, which is $2. and then you use your debit card, and if you needed some more cash to carry with you, you could say, I want a cash back of $20, and now you pay for the gum, and then you get a cash back, and then say $20 and $2 for the gum, $22 will come out of your checking account. Debit cards are attached, connected to your checking account directly, and they work very much like the credit cards operate procedurally, that they will have the Visa or the MasterCard logo on them, and you could use them at any place that you see those logos. Electronic transfers, you could make a wire transfer or electronic transfer from your checking account to any other checking account in the world, domestically or internationally. It basically just allows you to send money through your bank to another bank, to another person. And it's really convenient. It has certain commissions, obviously, that the financial institutions will charge, but allows you to have access to your money 24 hours a day. Now, savings accounts, on the other hand, are time deposits. Most of the time, you cannot write checks against your savings accounts. Now, some checking accounts will allow you to have overdraft protection. Overdraft simply means this. Say I have $1,000 at my account at Chase, and I wrote a check for $1,100. Now, if the check were to be presented at Chase, they look at my account, they see $1,000, the check says pay $1,100, I don't have sufficient funds. Now, if I have overdraft protection, then they're also going to look at my savings account. And in which case, if I have sufficient funds to cover in both accounts, they pay my check, and then they call me and they say, $1,000 has been paid from your checking and $100 paid from your savings account. So that's why I pause when I say you can't write checks against savings accounts. Most of the time, savings accounts do not allow you to write checks against it unless you have an overdraft protection. A connected checking account may actually use it for overdraft payments. Savings accounts are time deposits. You're basically saving money, and therefore they don't cost you, or the commission structure for the savings accounts is significantly lower compared to the checking accounts. You simply keep the money, and then most institutions will pay you some interest, very, very, very little, but still they will pay you some interest on this. There are money market accounts. There are type of savings accounts. They will pay you a little bit more interest, still very small, but a little bit more than the usual savings account. But they will limit how many withdrawals you can have from this account. So for instance, I really have an account at Chase, and my savings account, money market account, says that I can make withdrawals from the savings account 6 times any given month. If I were to make withdrawals more than 6 times, they will accrue commission. Now, certificate of deposits are literally time deposits. Now, these are, although they are listed as accounts, you actually buy them. So if you were to buy a certificate deposit from Chase, you are actually buying an account. What's nice about certificate of deposits is they pay a little bit more interest compared to savings accounts. They actually pay, in certain cases, a reasonable interest rate on your deposit. They are going to have fixed time and a fixed interest rate, although there are some certificate of deposits, CD for short, that have variable interest rates, or bump up interest rates. However, most of the time they're going to have fixed time and fixed interest rate, which simply means that, say you bought a certificate of deposit for 6 months at 2% a year, that means you're going to keep that money 6 months at that institution and you cannot touch that money. So unlike savings account, you don't have access to your money until the end of that maturity date, end of that 6 months. And if you do, there will be severe financial penalties to withdraw your money. So certificate of deposit gives you a higher interest rate, reasonable interest rate, but you are locked in and you lose control, access to your funds until the end of the maturity of those certificate of deposits. Now, monetary asset management refers to cash, checking accounts, savings account, money market accounts, and certificate of deposits. All the items that we just talked about. Now, there are deposit insurance institutions. So the first and most common is the commercial banks and savings banks. These are usually insured by the Federal Deposit Insurance Corporation, FDIC, although you need to make sure that your institution is covered by FDIC. Most banks are, but don't take it as given. Confirm that they do. And commercial banks and savings banks are regulated by the Office of the Comptroller of the Currency. So they are heavily regulated, and your money up to $250,000, $250,000 is insured by the FDIC as long as you have it in a commercial bank or a savings bank. The other type of depository institution called a credit union. We actually have one on campus. It is insured by the National Credit Union Share Insurance Fund. Works very much like a commercial bank. You could open an account with them, borrow money from them. But they're small institutions compared to Chase. Our credit union, for instance, on campus is tiny. However, they will have advantages for members. So for instance, as a student of Loyola, you actually have certain advantages at our credit union on campus. And they are a lot more local. They have their insurance is a little bit different, but still the funds that you have is insured by the National Credit Union Share Insurance Fund. Now, there are mutual savings banks. These are not as common, but they are insured. Your money is insured by the FDIC's Deposit Insurance Fund as well. But again, these are rare and they are not as common as commercial banks or credit unions. By the way, most universities will have credit unions on campus. So it's not specific to universities, but credit unions are specific to certain groups. So universities, I guess, group of students, student body, and they are created by these groups. And some of them may actually have non-profit or not-for-profit attributes. But all in all, the idea is to provide financial services to the members. Now, we have been talking about deposit insurance, and the maximum deposit insurance, $250,000. The details of this, you can refer to your textbook. It changes time to time. It used to be $100,000, but then in 2007 and 2008 liquidity crisis, all over Europe, deposit insurance amounts were increased, and US followed suit, and they actually increased it as well. So for the time being, maximum insurance is $250,000. If you have more than $200,000, it may be a good idea to split your money across multiple institutions just to make sure that you do not expose yourself to uninsured risk. Now, there are other providers of financial services, mutual funds, stock brokerage firms, and insurance companies. Now, one of my favorite is stock brokerage firms, companies like TD Ameritrade, Fidelity, E-Trade, and so on and so forth. Through these, you actually can have banking services. Most of these brokerage firms will allow you to have a check and a debit card, and have access and allow you to have access to your money 24 hours a day. And furthermore, you can actually buy stocks, bonds, ETFs, and mutual funds, also the financial securities through these brokerage companies. And you will earn a little bit higher interest through stock brokerage companies. Again, these are my favorite, although I have a bank account, savings account, checking account, and then I have a brokerage account, and I use them equally often. Mutual funds are actually portfolios managed by individual people or institutions that we could actually become partners of. They're not deposit insurance per se. There is no insurance, and your money is at risk because through mutual funds, you are actually investing. You're investing in a stock, gold, some other commodity, bond. Through mutual funds, you are making an investment. So it's more of an investment than a depository institution. Now, insurance companies, we'll talk about this in later chapters, but they offer two types of life insurance. One of them is called term life, which pays beneficiaries sum of money if you were to die. Now, this is definitely not a deposit institution in that sense. However, the second type of life insurance accumulates an actual deposit, if you will. Again, we'll talk more about this in later chapters, but in that case, it pays a death payment to the beneficiaries, and also it accumulates wealth into a retirement. Now, there are also insurance companies that provide annuities. That is, you purchase a product that pays you a monthly or an annual income for X many years. So as long as you do, the insurance company provides these two types of financial securities, they can be referred to as depository institutions. But companies like, Geico, where you buy your car insurance, obviously they're not depository institutions. But there are insurance companies like MetLife, for instance, that provides life insurance and annuity products that can be considered as depository institution. Now, based on the technology, we conduct our monetary asset management electronically. In fact, I don't remember the last time I went to my bank or my brokerage company. So we now have electronic fund transfers, wire transfers that we do online. We have plastic cards, ATM cards, debit cards, prepaid cards, credit cards, store value cards, and key fobs and smart cards. Now, debit cards allow you access to your checking account. Prepaid card works like a credit card. Most of them will have Visa or MasterCard on it, but think of it like the gift cards that you actually get. But sometimes, so the gift cards are specific to the store, but you can actually buy a prepaid credit card that actually has $50, $100, $500 on them already loaded. And it's actually a regular credit card. It has, it's referred to as prepaid card. And however much you loaded on them, you could actually use the whole thing. They're actually a good idea if you do a lot of online shopping, especially on international orders, because you're more likely to be exposed to financial fraud when conducting online businesses on websites that you may not trust all that much. Prepaid cards give you that peace of mind, at least, that you're not going to be losing your credit card information, but the maximum amount that you lose is whatever is on that prepaid card. Stored value cards are gift cards. We talked about credit cards. Now, key fobs and smart cards. Now, iPhone, Apple Pay, meaning I can actually use my credit cards or my debit card that is connected to my Apple card, and key fobs and smart cards work very much the same. In fact, the smart card refers to the RFID, which actually works the same technology with the iPhone, which simply means that you are accessing your checking account or your credit card account through different means, but still you're using the debit card or the credit card numbers that you connected through your cell phone. So perhaps Apple Pay. There's also Google Wallet. There's also Amazon Pay, and I'm sure there are others. With the new technology, there's significantly more. So if your credit card or your debit card is stolen, your liability is limited, but there's a time limit. You need to contact your bank as soon as possible. There are certain levels every institution will offer you, but there are federal regulation about this and a state regulation about this. So your liability may be dependent on the state that you live in, what type of card that you own, what institution issued you the card. So keep in mind that Visa and MasterCard are two financial institutions. And when the banks issue credit cards that have Visa and MasterCard logos on them, they are issuing a credit card by Visa or MasterCard, meaning your liability will be limited, but your immediate correspondence has to be with your financial institution. However, Visa, as the ultimate issuing financial institution, will have the actual processing. So, but your financial institution will be the intermediary for you. So your liability for the stolen credit or debit card is limited. However, you need to know that you have to contact your financial institution immediately and let them know that your credit card or debit card is stolen. Same thing applies to the errors on account statements. Your liability is limited. However, it's still, you have to let your financial institution know immediately. By the way, just as a side note, your checking account and your savings account, if your identity is stolen and somebody access your checking account or your savings account online and wire transfers money, there's not much you can do. So, and it's not like a credit card. You have to go through legal channels before you can see a dime of that money back. So it is really important that you take proper security measures on your checking and savings accounts and your brokerage accounts too, so that even if your identity is stolen, you won't lose money through these security measures. So for instance, I have a feature on my Chase account that actually sends me a text message immediately after each payment is made. And I have a cap on my checking and savings account that anytime a money transfer is requested, a same-day transfer is not allowed. And then anything over $100, I get a phone call, text message that says a money transfer is requested. Yes for continue, no for stop, and so on and so forth. So I have a two-step confirmation process, and you should too, because your checking and your savings account, your liability is not limited. Meaning, if your identity is stolen and somebody wires money out of your checking or your savings account, you may not get that money back, however the amount. So make sure that you take every security precaution that's available through your financial institution for your checking and savings accounts and brokerage accounts. So that's about it for our managing our checking and savings accounts. So thank you.